Right now, the term rescue capital is being thrown around a lot in commercial real estate, especially with the billions of dollars of commercial real estate loans that are scheduled to mature over the next few years. And with many of these loans facing interest rates that might be more than double the rate that they were paying previously, this is creating some really big problems for borrowers and has caused many lenders to pull back on proceeds, resulting in refinance amounts that are often not able to pay off an existing loan. This has led to a lot of capital providers starting to focus on solutions to bridge the gap for borrowers that can help them avoid having to sell at what could be the bottom of the market, while also avoiding having to make a capital call to equity investors at a time when property values have very likely decreased. So in this video, what I want to do is talk through what this rescue capital actually is today, where this capital is being used right now, and the impacts on investors and real estate professionals that want to take advantage of these changes that might be happening in the real estate market in 2024. So right now, when investors are using the term rescue capital, they're usually referring to preferred equity funding. On a traditional real estate deal that's financed with both debt and equity, the debt is usually a single loan from a bank, agency, insurance company, or debt fund that acts as the senior lender on the deal, and the equity is usually made up of only common equity holders. On the debt side, the senior lender will get paid first before any equity investors receive a distribution, and on the equity side, common equity holders will have unlimited upside potential but can also lose their entire capital investment in the case that they can't service their debt or they're forced to sell the property for less than the loan amount. These two sources of capital often make up the entirety of what's referred to in commercial real estate as the capital stack, or the funding used to finance a deal, with about 55 to 70% of funds usually coming from loan proceeds and the remaining 30 to 45% of capital usually coming from common equity investors. But sometimes, if common equity and senior debt can't or won't provide the total funding requirement to capitalize a deal, additional capital needs to be raised, and this is what's happening today as loan maturities are coming up in a significantly higher interest rate and cap rate environment than we saw across the market just a few years ago. To put this into perspective, if a property was acquired in late 2020 for $10 million at a 4.5% going in cap rate and financed at a 70% LTV ratio, the annual going in NOI would be $450,000 and the loan amount on the deal would be $7 million. But today, if that deal needed to be refinanced, that cap rate would now likely be closer to 6% for that same property, and the borrower would also likely see a much lower maximum LTV ratio due to rising interest costs that would increase debt service significantly on the deal. And even if we assume that the property saw an impressive 5% annual NOI growth over the 3-year loan term, and we assume that the new lender was still willing to fund a full 70% of the property's value at a $520,000 annual NOI and a 6% cap rate today, that same property would now be valued at just $8.6 million, and at a 70% LTV ratio, this would bring the loan amount to less than $6.1 million, resulting in more than a $900,000 shortfall just to pay off the initial loan before even factoring in new loan fees. And this is where preferred equity providers are really starting to come into play to fill in that gap in funding and help borrowers either avoid an unwanted capital call to their common equity investors or even avoid a distressed sale altogether at what could end up being the bottom of the market. Now, preferred equity can be structured in a lot of different ways, but in most cases, these structures are going to include two separate components of returns, with the first being referred to as current pay, which involves regular monthly or quarterly payments from the property's operating cash flow based on a percentage of the preferred equity amount, and the second often being referred to as an accrual rate, which isn't owed monthly, but will ultimately need to be paid at the end of either a predetermined time time frame or at the time of a capital event. And what's unique about preferred equity is that this capital sits right in the middle of the senior loan and common equity in the capital stack, with preferred equity holders getting payment priority above common equity holders in a deal, which reduces risk for preferred equity investors while also allowing them to generate materially higher returns than they would see if they invested as a lender on the deal. And in many cases today, with maximum LTV ratios on most senior loans down to just 60 to 65% due to the rise in interest rates, a preferred equity investor that comes in with something like 10% of the capital stack can see a property's value drop by 25 to 30% before their first dollar is at risk, which can make this a really attractive option for investors with dry powder. And from a borrower's perspective, or a sponsor that might be looking for a preferred equity solution to fill the gap in funding when they need to refinance, these types of structures can also make a lot of sense right now for a few different reasons. The first is that many common equity investors either won't be willing or won't be able to cough up additional funds if an unexpected capital call is made, especially when this is the result of a decline in property value. And to go back to our $10 million acquisition example, if we had to refinance at an $8.6 million valuation today and ended up with a $922,000 shortfall in proceeds, we would have to go back to common equity partners and ask for an additional equity contribution that would represent almost 31% of each investor's original investment in the deal, meaning that an investor that contributed $100,000 up front in 2020 would now be asked to contribute $31,000 more at a time when the property's value has dropped by almost 14%. And obviously, this can result in some really unhappy investors and realistically a situation where many investors either can't or won't fund additional capital, which can put the entire partnership at risk and could even force a sale just to pay off the loan. Preferred equity can also be a way for sponsors to essentially buy time in scenarios where they've seen and believe they will continue to see strong NOI growth going forward, avoiding selling an asset in what is very much a buyer's market today, while also giving a property's operations some time to catch up to interest rates that have in some cases almost tripled from 3 years ago. With that said though, even though preferred equity can be a helpful solution, this is referred to as rescue capital for a reason, and these structures don't come without downsides for common equity holders, with the first of which being the loss of control. Because sponsors are often negotiating these deals from a place of pending distress, the terms of these structures can be pretty punitive, and the clauses that might be added here are often things that the sponsor wouldn't end up agreeing to in more favorable market conditions. These clauses could include provisions to do things like give the preferred equity holder the right to dictate future refinancing or sale decisions, the right to replace the sponsor if the property's DSCR or occupancy rate drops below a certain threshold, and this could even involve common equity holders giving up some of the tax benefits associated with depreciation depending on how the terms of the deal are structured. Preferred equity can also create a significant strain on a property's cash flow in many situations where cash flow is already pretty tight, with a current pay of just 8% in our sample $10 million deal scenario, eating up almost 1.5% of our common equity investors' cash-on-cash returns, which are already in the very low single-digit range. Now, if you're watching this video and you're looking to find a job in this industry, how this might be relevant for you is that many companies are starting to roll out these products within their own platforms, which is creating job opportunities to deploy this capital when a lot of companies today are pulling back on hiring. Also, if you're an investor looking for a way to reduce your risk while also maximizing your returns as much as possible, preferred equity investments could be something to consider, especially if you're an accredited investor and you can invest alongside an experienced real estate operator. Now, obviously, the term rescue capital implies that there is inherently risk involved with these deals, so you want to keep your own risk tolerance in mind when choosing if you want to work or invest in this part of the industry. But right now, this is one of the fastest growing parts of commercial real estate that could present some really attractive opportunities as we head into the new year. And if you want to learn more about different real estate financing structures and the impacts of the capital stack on the returns of a real estate deal, as always, make sure to check out our all-in-one membership training platform, Breaking a CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Break into CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content on the channel on deal funding or the capital stack in general, make sure to hit the like button and let me know in the comments any other forms of financing that you'd like to see covered in a future video on the channel. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.